Got your eyes on a home? You'll need the local home loan experts at Guaranteed Rate Affinity. We are a fintech mortgage company that streamlined the home buying process. Our loan officers have direct access to the best real estate agents, giving you a completely seamless home buying experience. Featuring the industry's most advanced tech platform and customized loan solutions, our local loan officers can help you at any time from anywhere. Our digital mortgage and power bid approval will get you pre-approved in minutes with a strong offer even against all cash offers. You need speed to win in this market, and our same-day mortgage delivers, getting you approved in as little as 1 day. Getting you on track for the closing table in as fast as 10 days. Speaking of the closing table, our flash close options shorten the closing appointment from hours to minutes, or skip it altogether. It's your choice. We've made the home buying experience as fast, simple, and awesome as possible for countless others, and we'd love to help you next. Get pre-approved today with the experts at Guaranteed Rate Affinity, and let's get you home.
Good day, everybody, and thank you for joining another session with Guaranteed Rate Affinity on talking about some insights in the mortgage world. Last month, we had one of our top secondary specialist, Kate Moore, talking about mortgage products and how they can really help you, find more borrowers and get more clients into buying and selling homes. And the month before that, we had our Maddie Erickson, the head of our condo division at Guaranteed Rate Affinity, talking about the condo environment that's going around in the country. And today I'm really excited because this is super timely, especially right after the Fed announcement last week, and even the last couple of days with Jerome Powell's comments and commentary about the state of the economy as well. So we want to really help all of you as much as we possibly can to feel empowered when you talk to your clients in the possibility of buying or selling a house. And we feel like this is really going to help you out. This is something that we do consistently every single week at Guaranteed Rate Affinity with our loan officers, making sure that they understand what is going on and how to communicate and articulate this to all of our great realtor partners at Coldwell Banker and also any of the other borrowers that they may have in their sphere of influence. So with that, super excited to have Jeremy Collett. He is one of the top capital market leaders in the United States, happens to work for rate companies. Jeremy leads an incredible team of experts that is really kind of trying to navigate the challenging terrain over the last several years, especially. Rate companies and Guaranteed Rate Affinity are in prime position to really make sure that we're going to that next level of product and interest rates. So, Jeremy, excited to have you here. I guess we can probably get right into it. If you wanted to talk a little bit about the state of the Fed and what that means for mortgages.
Yeah, sure. Well, thanks for having me, Frank. I'm excited to be here. I've got the best job in the country. I've got a front row seat to all this. So like you alluded to, our team, everybody met Kate. So Kate's on the team. She manages product development, but we also set rates and for all these products that Kate teams rolls out. We manage all of our interest rate exposure, right? So when we give a rate lock to a borrower, we own that interest rate risk for, the 30 to 45 days or whatever the time is between, that rate quote and when it closes, and then between when it closes and we pull it up and sell it into the secondary market. So we're tuned into, the news, the market, the Fed, and the entire sentiment around all of that 24 hours a day. It's really an exciting role to have at the company. So anyway, last week's Fed rate cut, the Fed cut rates and mortgage rates went down, right? No, that is not what happened. That's not what we thought was going to happen. And just right out of the gate here, I think it's really important for everybody to understand that, one, the Fed doesn't set mortgage rates. Mortgage rates, and it depends on what product they are, but mortgage rates are really set by the market. And for the most part, the market sets rates on what they expect the Fed to do, right? So if you talk to any GRA loan officers, and we send market color and a weekly commentary and report on what's happening in the week, what's going on with the Fed, what's driving mortgage rates. The whole idea is to keep our originators at GRA in front of what's happening with the market. So we don't talk about so much that the Fed cut rates by 25 basis points. We were previewing this rate cut with them 3 months ago. So that's important because the markets are pricing in what they expect the Fed to do in setting interest rates or mortgage rates or treasury rates and yields based off of what the expected outcome is in the future. So when you hear people say this rate cut was already priced in, that's exactly what that means. Like the markets are trading on what they think the Fed is going to do. If you're waiting around for Jerome Powell to come out to that podium and tell you they just cut rates 25 basis points, you're too late. So unfortunately, or fortunately, depending on how you look at it, the Fed's influence is really massive in all markets now, not just bond markets and interest rate markets, but also the stock markets. You know, the general thought is, hey, if the Fed's going to hike rates or raise rates, that's going to slow down the economy, and stock market growth might be viewed as something to stay away from. However, when the Fed, it's perceived that they're going to be on a trajectory of cutting rates, that's when you see these, like even today, the stock market's rallying, or I should say over the last few months, as we've been expecting the rate cut that happened last week, the stock market's been rallying with the idea being Fed's cutting rates, that's accommodative for the economy and for growth. So companies are going to, you know, their business volumes are going to grow, their revenues are going to grow, and their profits are going to grow. So that's why you see not just the bond market, but also the stock market really pivoting based off of what the expectation of the Fed is going to do. So for the most part, interest rates, mortgage rates, stock prices had already factored in this rate cut last week. And that's why you saw rates not necessarily react so much to the cut itself. As a matter of fact, after the Fed initially cut rates, interest rates did fall a little bit. And it wasn't until Jerome Powell, it happens this way every Fed meeting, there'll be an announcement with sort of a prepared statement that gets released to the markets, you know, via the news, Bloomberg News, CNBC, you can follow along there. And then it wasn't until Jerome Powell's following press conference that markets started retracting a little bit or reversing that initial reaction. So when Jerome Powell came to and if you go just back one more to that previous slide, sorry. The main thing that Jerome Powell said that markets kind of centered on was he framed last week's rate cut as a risk management move and not the start of an easing cycle. So if you think about the Fed's dual mandate, and this is really important, right? They have their role is supposed to be very simple. They are supposed to use interest rate policy to manage inflation, you know, and that's what got us here from the pandemic, right? Like the Fed moved rates to zero during the pandemic, and the Federal Reserve started buying mortgage-backed securities and treasuries, all that designed to really keep interest rates low. And the whole idea was, you know, let's keep the economy afloat while everybody's on lockdown because of the pandemic. And I think it's safe to say at this point that they held that amount of accommodation for too long. And that's what led to 7, 8, 12, 15%, you know, depends on who you trust, inflation rates. So what did they do to offset that? They started hiking interest rates all the way up to 4.5% from zero to slow down the rate of inflation. And inflation's come down from, you know, 7, 8% CPI, which is, you know, sort of consumer prices, to the high 2s right now. The Fed's target is 2%, so we're not quite to their target, but there's still some room to work there, and that's been one of the main factors, you know, of kind of resistance to the Fed just cutting rates, because there's still some inflationary pressure, and we'll talk more about that in the slides to come. But what really I think triggered this cut and this comment around risk management what was the the softening of the job market that we've seen over the last few employment numbers. So job growth has basically come to a screeching halt here. There's still a lot of job wanted ads that postings across the economy, but even that number's starting to slip. And unemployment rate looks fine at 4.2 or 4.3%, but it's really the growth in the job market that's sounded some alarms here. So I think that's what he's talking about when he mentions risk management move. And of course the market's centered in on that and immediately came to the conclusion that this isn't the start of like a prolonged rate cutting cycle. This is just a little housekeeping in response to the latest round of really, soft job growth in the United States. So, Powell from there went on and talked about the emphasis on data dependence and its dual mandate, right? Kind of interesting if you think about it, like back in COVID, I guess you could make the case that the Fed was really focusing on the job market and maintaining full employment in the U.S. economy by dropping rates to zero, but it was really more of a economic stabilization exercise, which isn't part of their dual mandate, right? Their dual mandate strictly inflation and jobs. So anyway, fast forward to where we are now. They're back to watching inflation data, watching the job data come out, and really using that to dictate what future interest rate policy is. So really since that announcement and those comments by Jerome Powell at his presser, we've seen rates pretty much go up every single day since the Fed cut. In fact, mortgage rates are about 1/4 of a point higher than they were when the Fed cut rates by 1/4 point a week ago. So if you've been following the commentary and that rates are a product of what the market expectations are and not actually what happens, you're not surprised. If you were just looking at the headline and assumed rates would be lower, immediately when the Fed cut, you're probably a little surprised right now. But the market's always working on future expectations. So we can jump to the next slide then. Thanks. So what are expectations? And I get this question all the time, and people want to know, well, how do I track this? If the markets are looking at what they expect the Fed to do, where do I get that information? And it's a combination of things. The first one is something called the Fed dot plot. So basically all the voting members of the FOMC, they kind of put together a survey of where they think interest rates are going to be. And this sort of red line here, I'm colorblind, so is that red or orange? Not the white one, the other one. Frankie, you might have
green.
Green, sorry. Yeah, I do not see red and green, so I'm sorry about that.
You got me concerned there for a second.
Yeah, no, my bad. I can't see it though. But that's the Fed's median dots projection. And you can see right now they expect rates by the time we get to the end of 2025 to be about 50 basis points lower than where they are right now. So that means 2 more cuts for the remainder of the year at 2025. And then another, call it, cut or 2 in 2026, and then another cut, maybe 2 in 2027. And then it kind of flatlines after that. So we're not on, according to the Fed members, survey and estimates, we're not on a straight line down to lower rates. But this is a big part of what the markets use to interpret what the Fed's going to do over the next series of meetings, right? The other thing is, so you've got the Fed, you've got the dot plots, you've got speeches that the Feds make, and they talk about what they expect to do with interest rates in the future. And then there's also a futures market for short-term interest rates out 1 year, 2 years, 3 years, traded. These contracts are traded right here in Chicago. And if you want to get access to these, we can provide the links, but if you just Google Fed dot plots, it'll take you to the Federal Reserve's website, and you can see this for yourself. So there's no mystery to it. It's all out there and available to everybody. If you want to look at Fed futures, just Google it, and there's a page on the CME's website that gives you the same thing, but just in bond form. And that should give you some idea about, so you don't have to guess, you don't have to trust the people, the talking heads on TV. You can just go Google it yourself and find it. Both of those sources are out there. All right, we can go to the next one.
And while we're going to the next one, I wanted to, I get some questions usually every month. Frank, what's more important, consumer price index, the producer price index? The market moves quite a bit on those two numbers, and I'm curious, is that kind of fool's gold? Is it worth looking at that to kind of anticipate what the Fed may or may not do?
Yeah, no, that's a great question. And obviously, here's the other thing, like we're in a time of great political divisiveness, and everybody has an opinion on, what the president or the former president's impact on the market's going to be, and yada, yada, yada. With the Fed, it's pretty simple. It's inflation and it's employment. For employment, it would specifically be the employment report, which you're going to get the change in private payrolls, the change in non-farm payrolls, which is sort of the headline number, and the unemployment rate. And you also get wages and average hourly earnings and stuff like that. But first Friday of the month, the employment report comes out. That's extremely important to the Fed. In terms of inflation, their preferred index is something called core PCE index, and it's coming out here, I think, next week. I'm pretty sure it's next week. And then you get CPI, the consumer price index is probably the second most important one. But core PCE and CPI are, loosely track the same thing. It's really consumer prices. We're a consumer-based economy, so obviously, prices that consumers are paying are probably most important in terms of, the overall economy. But great question. But core PCE and the employment report.
All right,
so like
great.
Yeah, so mortgage rates, like I said, they actually rose after the cut. They kind of lingered on those comments that Powell made about, this not being the norm, that this was really a risk management move in cutting rates. And the bond market tones changed a little bit. So I always watch the 10-year, probably because I'm kind of getting old and I'm an old 10-year treasury, guy in terms of what our interest rates doing in the market. But, obviously for kind of psychological reasons, that 4% level on the 10-year is pretty important, to have the 10-year trading in the threes, 3.875, 3 3/4, whatever, would kind of signal that to me that the inflation battle that the Fed's been, waging here for the last couple of years is over. And obviously the 10-year traded right down to 4%. Jerome Powell came out and made the comments last week, and now let's see, I'll give you live. We're at 4.11 right now. So the 10-year's kind of pulled back from 4%. That's kind of the line in the sand that I'm watching right now, is that 4% level on the 10-year. So you guys might just want to save that. Like if you see, the 10-year get below that, and all of a sudden we start seeing 3.99 and 3.95 and 3.8, like then you can, assume we're kind of off to the races a little bit. But right now that seems to be like an important psychological level, but also like the market's gotten there twice this year and sort of just stayed there and then pulled back. So that's the range we're in right now. It bottoms out at a 4% level on the US 10-year note. So we can move to the next slide. It's just kind of recapping last week and where we're at. So this is interesting, and I know you can see right above 4% down there. I think it was 403 or 404. This is where that 10-year pulled back. So the range to me right now, until there's really some positive momentum in the inflation front, is that kind of 4% level at the bottom of the screen up to about 420 to 430, right? Like that's where I suspect interest rates will just trade until something drastic happens on the inflation front, or like if we just get like a massive uptick in unemployment, I think that would have the potential to move rates through the 4% range. But really, it's the inflation, right? At 2.7, 2.8%, core PCE or CPI. That's just well above the Fed's target of 2%. So we can move to the next one. Yeah, so mortgage rates, I already alluded, they're up about 25 basis points since the cut in less than a week. I think even today, like, the market tried to rally, mortgages tried to rally, and it just didn't hold. I don't know if there was some kind of comment. I know you had said Jerome Powell made a comment a couple hours ago, but I was trapped in conference calls, so I didn't catch it. But I'm pretty sure he went back and said, hey, we still have a massive slugfest against inflation underway. So don't get too caught up in the first rate cut. It doesn't necessarily mean we're going to continue cutting.
So that's what I wanted to bring this up, because almost exactly this time last year, the Fed cut rates by 0.25%, and what did it do? Rates slightly increased after that Fed announcement. This time it felt a little bit different. It kind of felt like this wasn't going to be as much of a head fake as it was this time last year. And I'm curious, is this kind of a buy the rumor, sell on the news kind of a market, or does it feel pretty certain that if we're going to get possibly another 50 basis points cut, by the end of the year, is there like a trading range or an idea as to like what would drive that 10-year down below 4? Because I'm also hearing from other folks that are saying, even if we get that 50 basis points cut, we still may not get below 4 on that 10-year note. Is that reliable, or that doesn't make sense?
No, I think that tracks. And one of the other things that Jerome Powell said, and I can't remember if I read it this morning or if it was from his press conference last week, but the risk to inflation are to the upside, because there are a lot of ongoing trade disputes, trade wars, tariffs, things like that. And none of them are particularly good for consumer prices. You know what I mean? So in other words, like, I don't see how any of that makes consumer prices fall. You know what I mean? It can only kind of get worse because of it, especially when you start to factor in things like deregulation and tax cuts, right? There's just going to be more demand. There's going to be an invigorated consumer that now they've got a bigger tax refund and they're out ready to travel and purchase things. So the risks to inflation are definitely for inflation to move higher from here, not lower. On the other hand, you could say the opposite about the employment market right now. At 4.2% or 4.3% unemployment rate, the risk for that to improve because of everything that's going on in the economy are pretty low, right? So the risk for the employment market is for it to deteriorate further. And those two kind of conflict with the Fed's mission, right? Because, on the one hand, a worsening job market would definitely put the Fed in a position to start cutting. But if you think about what they've been doing for like the last 4 years, it's been inflation, 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 right? So you kind of feel like that takes the, priority with the Fed, especially since 4.2% unemployment is, historically low still. So I think that's what it would take, is some surprise inflation reading that shows that prices cooled pretty dramatically. And I don't know how that happens, but to answer your question, I think that's what pushes interest rates significantly lower. And it's a long shot. So let's go to the next slide. So yeah, these are just some numbers from the inflation, employment. I think we added some charts to this too, but core PCE, that's the Fed's main gauge, came in at 2.5% quarter over quarter. The month over month numbers were even worse. It was like up 2.7 and 2.8% the last couple of reports with super core, and that's just like a really drilled down that excludes volatility from like fuel prices and food. That was up 0.5% month over month. We're looking for like 0.2 or 0.3 month over month to show some progress on the inflation report, on the inflation side of things. Initial jobless claims have been trending down. So it's kind of weird, like job growth has stopped, but the claims number, so people filing unemployment, either continuing or for the first time, they've been pretty flat, so there's a little bit of a mixed signal from the job market. And then, the good old American consumer is as dependable as, the weather changing. Retail sales has been steady. People are still out spending money. If you guys have traveled or gone out to dinner recently, like you see it. So the consumer's like a cockroach here. You just can't get rid of them.
We were just in Las Vegas last week for the Gen Blue conference, and to say that people are just, I don't think I've ever been to Vegas where I've seen things so expensive, and there were like lines for people just giving their money away. So it felt pretty positive. If I was Jerome Powell and I was in Las Vegas last week, I would say things are looking pretty good. But there's no doubt. I feel like we're kind of back in that tried and true market for interest rates, where good news is bad news for interest rates, and bad news, then the vice versa. So when we get a negative kind of unemployment report, it seems to be now kind of an indication that rates probably will tail down a little bit. And for those of you that may have been in Las Vegas last week, and we had some great speakers talking about the economy, really one of the big takeaways was the unemployment is really some of the key figures to be watching over the next few weeks and few months ahead.
Yeah, and I've got a really cool chart on here. I think is it after this one?
Here we go.
Yeah, so this shows core PCE, right? So on the left there, and they're spending, right? But core PCE, that's the Fed's preferred metric there. You can see it just shooting up, over the last 5 months or so. So it was getting close to zero there. Somewhere that's probably May, and then now up to 0.3. And then that last slide, you could see the super core was up to almost 0.5%. So spending, that's kind of been up and down and ebbing and flowing, but for the most part, all the consumer metrics have been really strong. And then the next slide's pretty interesting too. This shows unemployment rate and the change in non-farm payrolls, right? So the blue lines, I can see that color. You can see the change in non-farm payrolls month over month has pretty much just gone straight to zero since 2021. Since we recovered from the pandemic, or at least started to get back to normal a little bit. And then the unemployment rate still pretty low, comparatively speaking, at 4.2%. With the change kind of dropping a little bit as non-farm payrolls have flatlined. And I think that might be it, unless did I put a slide in here, one more, just kind of forward looking?
You did, and I would love to kind of finish up the next few minutes and kind of talk about, where's kind of your brain at, the rest of your colleagues in the capital markets industry. And I think we were all kind of hoping for a little bit more of an easing rate environment over the last couple of weeks. But it kind of feels as though this is kind of the range we're going to be in for a while, and wanting to hear what your take is.
Yeah, I mean, you get me started on that subject, we'll be here a while. But if you think about kind of our generation of people in this industry and home finance and all that, like we've really benefited from like a steady trajectory of rates kind of falling at least every few years. And the whole market was based off of this kind of refi boom cycle, that happened periodically. And eventually that trend just led to zero interest rates, and then I always it's so funny because I pulled this chart up and I made this probably 20 years ago. I'm like, wow, we're just heading straight down. What happens at the end of this? And I think that's where we're at now. So, my kind of mantra on the desk is, forget what you used to do, because it's over. Like once the Fed put rates to zero and interest rates factoring in inflation were effectively negative, right, throughout the pandemic, like that was it. And that was a generational market. And of course, the consequences of that were a really gnarly hangover, right? At least in our industry, where home prices skyrocketed, rates skyrocketed, and that cycle of purchase, refi is probably broken for probably the rest of our careers. Maybe my kids will get to, experience some of what we went through, but I do think that's over. So this kind of hand-to-hand combat for deals and getting mortgages done and winning clients is here to stay. So, what do we do about it? We learn how to do different kinds of products and facilitate the purchase of deals that maybe were a little too tricky to really focus on 5 or to 10 years ago. You know what I mean? So non-QM's been huge. People have a massive buildup of home equity. So we're working on bridge products and home equity products and things that are, applicable to the situations that homeowners have today. So now you're seeing marketing and AI and data science really take shape. And, I know how we're acquiring new customers and serving our realtor referral partners. Like all that's changing really rapidly and becoming more complex. And that's the bottom line. I mean, there's no free lunch. I think this market with what we think are higher rates is probably here to stay. So the whole company has been learning new products and adapting new technology to become leaner and meaner and faster and more efficient. The wild card here is probably Fannie and Freddie. Like they have so much influence over what rates are that whether they end the conservatorship of the GSEs or not is probably going to have a big impact on rates. Like what I think could happen is Fannie and Freddie get pushed out of conservatorship and reintroduced, and then they have to compete for business like the rest of us. I think ultimately that's going to be good for mortgage rates and for consumers. So I'm kind of excited about that, even though there's this, stream that ending conservatorship will lose the explicit guarantee and all that. I think that'll always be there, but I'm looking forward to them having to compete for business like the rest of it. I think it'll be good for consumers.
Yeah, that's a great insight. And by the way, just non-QM stands for non-qualified mortgage. And really what that allows our loan officers at Guaranteed Rate Affinity to do is to find your home for your borrowers that maybe need different types of proof of income, maybe bank statement loans where they don't get W-2s or their 1099s are crazy, but we can provide their bank statements. Amazing. Jeremy talked about the amount of equity built up in people's homes, and there's nothing more exciting right now than reverse mortgages for people that are at that back third of their life to be able to get a lifeline financially and to help them out. Renovation loans are amazing. Guaranteed Rate Affinity has 11 bridge loan products to help your borrowers. You get that financing between their current home and that future home that you want to help them to get. So we are doing everything we possibly can to make sure that great borrowers are finding opportunities to win a deal. And we also have great products to help you even compete against cash offers, or even compete against builders that have a 4.5% or 5% sign standing outside of a new construction property. All of your Guaranteed Rate Affinity loan officers around the country get this kind of insight on a weekly basis from myself, from Jeremy Collett, and from the rest of our capital market and secondary leaders. And we take coaching and training our loan officers to the extreme. So they are all prepared and they're happy to answer your questions and follow up. But everyone, I just wanted to thank you for your time and your participation today. Please, again, this partnership for Guaranteed Rate Affinity and Coldwell Banker is really exciting for us. We're excited about the future of Coldwell Banker. And so please, we're going to be doing these calls once a month to help you get insights on the mortgage industry and how we kind of talk to borrowers, how we can help all of you. So Jeremy, Collett, thank you so much. Appreciate your time. And everyone else, thank you. And everyone else, have a great rest of your day and hope to see you next month on our next call. Take care.
Got your eyes on a home? You'll need the local home loan experts at Guaranteed Rate Affinity. We are a fintech mortgage company that streamlined the home buying process. Our loan officers have direct access to the best real estate agents, giving you a completely seamless home buying experience. Featuring the industry's most advanced tech platform and customized loan solutions, our local loan officers can help you at any time from anywhere. Our digital mortgage and power bid approval will get you pre-approved in minutes with a strong offer even against all cash offers. You need speed to win in this market, and our same-day mortgage delivers, getting you approved in as little as 1 day. Getting you on track for the closing table in as fast as 10 days. Speaking of the closing table, our flash close options shorten the closing appointment from hours to minutes, or skip it altogether. It's your choice. We've made the home buying experience as fast, simple, and awesome as possible for countless others, and we'd love to help you next. Get pre-approved today with the experts at Guaranteed Rate Affinity, and let's get you home.